Let's now move on to part C. Makazi Limited's current earnings per share is 6 shillings. The firm has in issue 50 million ordinary shares which have a par value of 20 shillings. The firm's total revenue and capital reserves amounts to 500 million shillings. The company has an asset beta of 0.9 and a retention ratio of 60%. The management of Makazi Limited intends to undertake a financial reconstruction which will result in a debt equity change from 0.45 to 0.2. What's the question? Additional information is, number one, the risk-free rate is 8%. The risk-free rate of return is 8%. Number two, expected rate of return of a market portfolio is 18%. Number three, corporate tax is 30%. Number four, the firm's return on equity before and after the financial reconstruction will remain unchanged. Required, evaluate the impact of the financial reconstruction on the firm's share price. The impact of the financial reconstruction on the firm's share price, 8 marks. 8 marks. So candidates, how do we evaluate the impact of the financial reconstruction on the firm's share price? We'll compute two share prices, one before the reconstruction, then we'll compute the share price after the reconstruction, then we'll do the evaluation. We will check whether the evaluation led to an increase in the share price or led to a reduction in the share price. That is the formula. We calculate the share price before reconstruction and after reconstruction. Then we, all right. So let's now begin. I'm going to first calculate. So candidates, we are going to calculate the value of a share. This is C. We'll calculate the value of a share before reconstruction. Is it reconstruction? Yes, before financial reconstruction. And we know, candidates, the value of a share P naught is equal to D naught 1 plus G over cost of equity of levered firm minus G. So this is the formula for calculating the value of a share before reconstruction. Then we will calculate the value of the share after reconstruction. Then we compare the two and see the effect of reconstruction on the value of a share. So do we have these values in the question? No, we do not have these values. We need to work out these values beginning with dividend per share. D naught is dividend per share. G is the growth rate. We don't have the growth rate. The cost of equity for the levered firm, we do not have it. We will have to work it out. So let's work out those variables, the inputs. Let's begin with the dividend per share. Dividend per share D naught is equal to, we will use the information given to calculate D naught. In this question we are told that Makazi current earnings per share is 6 shillings. The firm has in issue 50 million ordinary shares which have a par value of 20 shillings. The firm's total revenue and capital reserves amounts to that. Then the company has a asset beta of 0.9 and a retention ratio of 60%. 60%. So dividend per share will be equal to the payout ratio. times the EPS. Payout ratio times the EPS. In this question, we have the retention ratio is 60%. Retention ratio. If the retention ratio is 60%, then the payout ratio is 40%. That is 100% minus 60%, giving us 40%. The EPS is 6 shillings. Therefore, the dividend per share is equal to 40% of 6. 40% times 6 is 2.4 shillings. 2.4 shillings. So candidates, here we have the D naught, which is equal to 2.4. Then we are going to work out the growth rate. The growth rate. Growth rate G, candidates, using the Gordon's growth model, we know that growth rate is equal to the retention or return on equity times the retention ratio. Return on equity times the retention ratio will give us the growth rate. And the retention on equity, candidates, the retention on equity is equal to the net income divided by equity. Net income divided by equity. The net income. What is the net income? We read that the firm has in issue 50 million ordinary shares with a par value of 20 shillings each. 20 shillings each. Then we read that the firm's total revenue and capital reserves amount to 500 million. 500 million. So we have equity there, candidates, of equity there is 50 million ordinary shares. Ordinary shares, 50 million ordinary shares. So we'll have 50 million ordinary shares times the par value of the shares is, the par value there is 20 shillings. That is ordinary shares or ordinary share capital, plus the total revenue and capital reserves of 500 million plus 500 million shillings. 500 million shillings. So we need to determine the net income. The net income, candidates, is just the earnings. We read that in the first sentence that the McCarthy Limited's current earnings per share is 6 shillings. Earnings per share is 6 shillings. That is the earnings. Earnings 6 shillings per share. So 6 shillings times number of shares, the number of shares 50 million. Okay? This is 50 million. That will give the return on equity. So we have this is 50 times 6 is 300. That is the net income. We are going to divide 50. This is 50 times 50 million times 20 plus 500. It's 1,500. That will be equal to 300 divide 1,500, 0.2. So 0.2 is the return on equity. Return on equity. So we have the return on equity here, 0.2. We multiply by the retention ratio. The retention ratio If the payout ratio is 40%, the retention ratio we are given in the question is 60%. Therefore, the growth rate will be 0.2 times 60, which is equal to 12%. 12% is the growth rate. The growth rate here is 12%. So we have 1 plus 0.12 divide by the cost of equity of the levered firm. Cost of equity of levered firm. How do we calculate the cost of equity of levered firm? Cost of equity of a levered firm. Candidates, using CAPM, the cost of equity of a levered firm is equal to the risk-free rate plus beta, the beta of levered firm into RM minus RF. This is the premium. That gives us the cost of equity of a levered firm. Cost of equity of the levered firm. Now, do we have all the inputs in this formula? Yes, we have the risk-free given. Risk-free is 8%, that is 8. We have beta for the levered firm. Beta of the levered firm, we are given some beta somewhere. We read that the company has a beta of 0.9. 0.9. But candidates, that is the beta of this firm, which is unlevered. Okay, this beta given here is the unlevered beta, beta for the levered firm. But here, candidates, this is beta for the levered firm. This one is unlevered. The beta given in the question is a beta, the asset beta 0.9 of the unlevered firm. So we need to calculate the beta for the levered firm. So candidates, how do we calculate beta for the unlevered firm? Beta for the levered, this is levered. The one here is the unlevered. So candidates, using the Hamada model, the beta of the levered, because you need the beta for the levered here, the beta of the levered firm is equal to the beta of the unlevered firm into 1 plus D over E, 1 over E, 1 minus T. That is the formula for beta for the levered firm. So we need to calculate this beta so that we can apply it there to calculate, to determine the cost of the levered equity, cost of equity of the levered firm. And this cost of equity of the levered firm is what we need in determination of the value of the share before reconstruction. Okay, are you following, candidates? Are you following the process, mathematics? We are working out step by step. First of all, put down the formula. The value of the share before reconstruction is equal to P naught into, which is equal to P naught, which is equal to D naught into 1 plus G over KEL minus G. All these variables were not provided in the question. So we are working out these variables one by one. So far, we've determined the dividend per share. We've calculated the growth rate. We are now working out the cost of equity of a levered firm. Cost of equity of a levered firm, candidates, we've seen that using the CAPM, the cost of equity of a levered firm is equal to the risk-free rate plus beta of a levered firm times the premium. And in calculating the cost of a levered firm using CAPM, we need to determine the beta of a levered firm, which we do not have in the question. So using the Hamada model, we are going to work out the beta of the levered firm, which is equal to the beta of the unlevered firm into 1 plus d over e times 1 minus t, which is equal to the beta of the unlevered is what we have in this question, 0.9 into 1 plus d over e. This is a ratio which we also have in this question, the debt equity ratio. We read that the management of Makazi Limited intends to undertake a financial reconstruction which will result in a debt equity ratio. A debt equity ratio change from 0.45. That is the debt equity ratio. This is the debt equity ratio, 0.45 times 0.7 times 0.7. That will give us the beta of a levered firm. So I'm going to have 0.45 times 0.7 plus 1 times 0.9. This is equal to 1.1835. This is the beta of the levered firm. So this beta of the levered firm, we are going to write it here, plus 1.1835. Then we multiply the premium, the return minus the risk-free rate. Do you have the return? Do we have it? Yes, we have it. The expected return of market portfolio is 18% minus the risk-free rate 8%. Therefore, candidates, the cost of equity of a levered firm will be equal to 10, 18 minus 8 is just 10, times 1.1835 plus 8. This is equal to 19.835. 19.835%. Therefore, candidates, the value of the share before reconstruction will be equal to 2.4 into 1 plus 0.12 divide by 19.835%. When converted into decimal, this will be equal to 0.19835 minus G minus growth rate 12%. When converted into decimal, 0.12. Therefore, candidates, the value of a share, this share will be equal to 2.4 times 1.12 divide by 0.19835 minus 0.12. This gives me shillings 34.30. That's the value of the share before reconstruction. We will now calculate the value of the share after reconstruction. The value of this share after reconstruction. The value of the share after reconstruction. Then we compare. We're going to compare after calculating the value of the share after reconstruction. We see what is the effect of reconstruction on the share. Effect of reconstruction on the share. So we calculate the value of the share after reconstruction. This is financial reconstruction. The value of a share will be equal to P naught is equal to D naught 1 plus G divided by K E L minus G. So therefore, candidates, the dividend per share will remain 2.4. The growth rate will remain 1 plus 0.12. The cost of equity of the levered firm will change. That's the only thing that will change, and will change because the beta, okay, the beta, we read here that the beta in the third sentence down there, we read that the management of Makazi Limited intends to undertake a financial reconstruction which will result in a debt equity ratio change from 0.45 to 0.2 Now, using Hamada, we will have to Hamada model. We are going to change this 0.45 because it is changing from 0.45 to 0.2. So the beta for the levered farm after reconstruction will change to 0.2. So therefore, what will be the beta? The beta is going to be 0.2 times 0.7 times 0.7, which is equal to 0.14 plus 1, which is equal to 1.14 times 0.9 is equal to 1.0226. The beta for the levered farm will change to 1.026. Therefore, candidates, the cost of equity of the levered farm will also change. Using CAPM will also change. Let me just use this place to work out the CAPM. Using CAPM, we are going to change this. Beta will change. That beta will change to 1.026. Therefore, this will change after reconstruction. Again, this is going to change 1.026 times 10. This is 1.026 times 10 plus 8. So the new cost of equity of the levered farm is equal to 18.26. That is the only thing that changes when calculating the value of the share after financial reconstruction. The cost of equity of the levered firm will change to 18.26%. When converted into decimal, this will be 0.1826 minus 0.12. Therefore, the value of a share will be equal to 2.4 times 1.12 divide 0.1826 minus 0.12. This is equal to 42 shillings and 90 cents. 42 shillings and 90 cents. So candidates, we have calculated the value of the share after reconstruction, and we have found out that after reconstruction the value of the share goes up from 34 shillings and 30 cents to 42 shillings and 90 cents. 42 shillings and 90 cents. That is the effect. The question was, evaluate the impact of the financial reconstruction on the value of share price. The share price has gone up from 34 shillings and 30 cents to 42 shillings and 90 cents. That is 8 marks. 8 marks. 8 marks. 8 marks. Candidates, 8 marks. You get also marks for all these workings. Okay? Workings. These inputs were not provided in the question. The candidate, that's why I always tell you, before you answer any question, put down the formula. It is this formula that guides you on how to earn the marks, because out of this formula we saw from the question that none of these inputs were provided in the formula. So a candidate getting marks, you don't have to score all the marks, but you can at least score some marks. Out of these 8 marks, you can score some marks, because by now you know how to calculate the dividend per share. There are many ways in which the DPS can be calculated, and that depends on the information provided in the question. We know dividend per share can be the total earnings attributable to shareholders divided by the number of shares. Sometimes you can be given the payout ratio and the PEPS, so that you can determine the D naught. So if calculating D naught, you get a mark. You may not remember the Hamada model, but you can at least get the marks for the DPS. You can at least get marks for growth rate. These are concepts we learned in section 3. You can score some marks for growth rate. Okay, you can score marks for even just putting down this formula. You can earn some marks. So out of these 8 marks, you don't have to score all the marks to pass your exams. You can raise easily 8 marks easily from this question that looks a bit technical. So at least candidates, these are questions that are repeated. If you check question number 4, this question that we have answered is similar to the question we answered in November 2019, where candidates were expected to calculate the exchange ratio, maximum payable price, which requires you to remember the exchange ratio. So as you prepare for your exams, please make sure you memorize the formula. Memorize formula. Then you will be in the right direction in passing your exam. So thank you for attending our today's revision session. In our next session, we are going to answer the last question that was tested in May 2021. We've done question 1 up to question 4. Next time I appear here, I'll tackle question number 5, and I can see question 5 is also a very interesting question. It is a question that required candidates Roman A, and that is part A, to discuss four circumstances in which a decision could be made to liquidate a failing company rather than attempt to carry out reconstruction. Part B, examine 4 advantages of investing in real estate. You can see, candidates, these are marks that required common sense. What are the advantages of investing in real estate? Then part C, candidates were required to construct a decision tree to depict payoffs and hence determine the expected net present value of a project. There is information given there regarding a project by a company Z Tech Limited, which wishes to design a new product so as to catch the interest of their largest market, which is currently very competitive. Part 2 of C required candidates to calculate the project's expected standard deviation and coefficient of variation. These are common questions. So make sure you keep revising, and as you revise, avoid just looking at the answers in the books or just watching these videos the way you watch movies. Make sure sometimes you sit down with a complete sitting. Take, for example, May 2021 sitting, do the whole 5 questions in 3 hours, then you can go back and check if your answers are correct. Continue practicing what we call active recall, and you'll have a very easy time in tackling examination questions. Thank you. God bless you. Bye-bye.